fee-only financial planning and investment management firm located in Indianapolis, Indiana. She has been constantly named to the National Top Financial Advisor list published by Worth magazine since 1994. She has also been featured as one of the 150 best financial advisors for doctors in medical economics, published in August 2000 and July 1998. Ms. Bedell's professional career includes Director of Personal Financial Planning at Coopers & Lybrand and Vice President and Trust Officer at the Indiana National Bank. Ladies and gentlemen, please welcome once again Ms. Eleni Bedell, who will speak on the topic, How to be Successful as a Fee-Only Financial Planner.
Thank you. Good afternoon. And I understand my challenge is to keep you all awake until the coffee break. And as you may know, the schedule has changed just slightly, so we will try and complete by 3:20 to keep everyone else on schedule. Thank you for joining us. Thank you for choosing to come listen to me speak. My topic was successful as a fee-only planner. And the first comment I really would like to make is that that doesn't mean that fee-only planning is the only way to do financial planning. In fact, whether you charge a fee or whether you are compensated through commissions is really not as important as the fact that you are responding to your market and that you are doing financial planning, putting the client's interest first and using the six-step process that we'll talk about. So I just wanted to give that little disclaimer that even though this is the way I practice, it works for me and it may work for some of you, but if your market is a little bit different or you've organized your practice different, as long as you're serving your clients well, you'll meet the objective. A little bit of an overview of what we'll talk about. I always like to start with defining financial planning, but probably to this group that's not as necessary, so we'll go through that quickly. I'll talk about the evolution of financial planning profession in the United States because I think that will give you a little bit of perspective on where we are in the States and maybe where you are currently in Malaysia. And then we'll talk about fee-only financial planning, and we'll probably spend most of our time there. And please feel free, I know it's sometimes difficult in a large room like this, but if you want to ask a question, please feel free to show a hand and come forward with your question. I do want you to get some value from this presentation today, so ask your questions. Definition of financial planning, and this is sort of the way I explain it to clients, that financial planning is utilizing your financial resources in the most efficient and effective manner to accomplish short and long-term goals. So you're trying to help the client get a handle on the total picture. We're not looking at any one area. We want to look at all their financial resources and how to make them work together. Financial planning is a process. It's a process of determining how a client can meet their life goals through proper management of his or her financial resources. It's dynamic. It's constantly changing. It's an evolving process. And the financial plan itself must change as your client's situation changes. So once you do a plan for the client, that work may be done for a period of time, but it's going to be necessary to continue to work with that client, and as things change in their life, update the plan. The six-step process that we all talk about, just to put it up there so we have a clear understanding again, the six steps are listed there. The first is to establish the client relationship. Make sure the client understands, as a practitioner, how you work, what your method is, how you're compensated. Discuss all that up front so the client feels comfortable moving forward with you through the process. The second step then is to gather client data, including exploring with them what their goals and objectives are. And I can't emphasize enough how important that is to get a good feel for what the client is trying to accomplish. When the client comes to see you, they have something in the back of their mind that motivated them to come. And if you can discover what that is, And then through the planning process, if you can resolve that issue or answer that question, you will have done a great service and you will have provided a financial plan that really meant something to the client. So it's very important to determine what it is that made them come see you and ask for financial planning. And you do that through that step of the process. The next step is where you go to work and you analyze and you evaluate the client's current situation. What are they doing now? How much money are they saving? How do they have it invested? How much insurance do they currently have? What kind of estate plan do they have? You look through all of that and get a good feel that you understand what they're doing now. And you know what? You may say at that point, hey, I think you're doing everything right. And you validate that they have a good plan in place and they should just keep moving forward. But on the other hand, you may find some ways to make it more efficient and more effective. So step 4 comes into place, developing and then presenting to the client recommendations and perhaps even alternatives to those recommendations. Financial planning is not a science as much as it is an art. And sometimes there's really more than one way to help a client accomplish their goals and objectives. And here might be a place that you may say, this works, or likewise, this plan would work as well. So you present back to the client. Now, at that point, you've provided the client this information, and hopefully along the way, you've given them a good education on how you came up with those recommendations. So you've laid out to them a very logical plan. Here's where you are today. Here's what you need to do differently to accomplish the goals and objectives that you set out for yourself. And here's my recommendation. Now, implement the plan. And that might be where you sell them an insurance product or you choose some investments for them. But at that point, it's not selling. At that point, you're just implementing the plan. And if you've done a good job in the previous steps of the process, the client's going to say, I understand. That makes sense, and so those are the products that I need. Now, whether you sell the products and earn a commission, or whether you work with another advisor because you don't sell products, you're fee only as I am, you work with another advisor, but you do get the right products in the right place. Now, the other thing that's very important through this process is that we've always put the client's interest first, in place of and in front of your personal business interest. And what I mean by that is that no matter how you're compensated, be it fee or commission, there are opportunities where you might look at something and say, I'd personally be better off from my business standpoint if I directed them this way. Even though maybe that's not quite as good. Don't ever do that. And there's lots of reasons why not to. Because as soon as you push them over to this direction, and maybe it's because it's got a little bit higher commission, and it may sort of meet their needs, somebody else is going to come along and say, why did you do that? You could have done this, this, and this. Didn't your planner tell you that? And if the answer comes back, no, they didn't even mention it, and then they find out that maybe you wouldn't have earned as much on that product, guess what? You've lost all credibility. And that client is not going to tell their friend what a great job you did. In fact, they may go the other direction and say, I'm really sorry I worked with that person. That will really hurt you in your market. In this kind of a business where it's such a personal relationship type of business, your reputation and your credibility is everything. So you want to make sure you serve your client in the best mode. And I will give you an example in the United States where I can find myself in that kind of a situation, even though I don't make commissions by selling products. But we happen to have something in the States called the 529 plan, and it's to save for education funds. And there are tax benefits to use that plan. But in that plan, those dollars go off to only certain institutions that, in essence, invest the dollars. Well, part of my business is to invest dollars for people. I can't invest those dollars. I can't earn a management fee because they're over here in a separate account. But you know what? I know many times that's the place the client's dollars should go. that's better for them to accomplish the goal of accumulating education funds for their children. And so I always make sure the client knows that option is there and recommend it. Because if I didn't, and they find out from somebody else that that was the best plan for them, I'm hurt. And so I will not do that. I won't compromise my integrity and lose my credibility with the public, because then I think my business would be jeopardized. So that was a little off on the side, so sorry I got so involved there. So implementing the plan is very important. The last one, monitoring the plan, which also means reviewing and revising the plan, is just as important. To keep up to date with the client and to make sure that if there's necessary to change some of the plans, modify the investment structure or the insurance or the estate plan or the income tax plan, it's important to do that. Areas included in financial planning, again, it's broad-based: cash flow budgeting, debt management, income tax planning, investment strategies, insurance needs analysis, education planning, retirement planning, estate planning, charitable planning. It purely comes down to anything that has to do with your money. That is what you as a financial planner may be getting involved with your clients. And as I mentioned, it's a dynamic process. The plan needs to change as the client's life stages change. And I just have briefly noted some of the changes that clients go through. They may be young, and they're young, single, or married couple. The next step may be to buy a home. Well, what does that mean? Look for a mortgage, maybe more life insurance to make sure we can cover that debt. They become parents, more life insurance to cover dependent needs, maybe some other issues, writing a will to name a guardian. Maturing career, do you see a change happening in a maturing career where there's maybe more discretionary dollars, more investment decisions? Accumulator of assets. Divorce or widowhood comes into play, changing again the plan, requiring maybe you to sit down and determine, are there new goals or objectives that need to be considered now that you've moved into a different stage of life? Retirement is an easy example of that as well. When we move into retirement, most likely that investment portfolio needs to look different, because where we were wanting the dollars just to grow in the past because we had our work income to meet our living needs, we now need to maybe change that investment portfolio to provide us with income to replace our earned income to meet our living expenses. Elder care issues, long-term care comes into play there, estate planning issues, and the list can go on. But again, I meant to just present to you the fact that people's lives change and their financial plan needs to change along with them, because goals and objectives change, assumptions need to change, situations change. The evolution of financial planning. Actually, we would say that the financial planning industry started more than 30 years ago in the United States. And actually, it was first promoted by life insurance professionals. And what it was is a few individuals who decided a more holistic approach to planning versus the sales approach that they had been used to doing would make more sense, because they saw their clients had multiple needs. And they wanted to start examining those needs in a more detailed and, again, holistic approach. So they sort of started, this band of renegades sort of started this new process called financial planning. Financial planning was provided by professionals who were compensated primarily by commissions earned on the sale of those products. So financial planning came from a commission-based environment. And so you can see that that was the way that most people were going to be compensated. Today, financial planning is provided by professionals who are compensated by commissions, by fees, or both. A fee-only planner receives compensation only from the client. So they don't receive any commissions on the sale of products, such as insurance or investments, where a third party, the insurance company or the unit trust, would pay them the commission for selling that product. So that's the simplest definition I can give you. Fee only means that the client is the only one that pays you. A fee-only practice emphasizes financial planning. Let me catch up here. One thing I wanted to mention when I said fee only, and that's what I had written down. Sometimes we get a term confused in the United States, and I want to clarify it here. We have fee only as I just defined it. There's also something, a term thrown out quite a bit called fee-based. Fee-based really means charging a fee but also receiving commissions. So it's a combination. But the term fee-based has begun to be a little bit confused with fee only in our public press. And so I try and take every opportunity to kind of clarify that. So be careful the term that you use so it does describe the way that you do business. And then of course there's the commission only practices which don't charge fees for the plan. Back to a fee only practice tends to emphasize the planning process. And generally the clients that we serve have a little bit more complicated issues. Something where you need to take some time and sit down and evaluate several things. They may be a little more high net worth, where they've got more tax issues or estate planning issues to deal with. They may have more assets in general, more complicated types of investment schemes that they're working with. So those are the typical clients that we would see with a fee-only planner because they'd be more likely or more willing to pay a fee for that kind of analysis. And they understand that there generally is true mathematical analysis that is going in as you evaluate currently what they have, what you think it will grow to, and what changes they should be making. The clients usually want unbiased advice. And just to explain that a little bit, there's a concern in some environments that if I'm selling a product and earning a commission, that as I spoke earlier, I might be anxious to steer the person to the product that will earn me the commission. And so the public has gotten to a point, again, this is in the United States, where they have come to prefer someone in many cases who doesn't have a connection to selling a product. That they can lay out and say, here's exactly what you need. And it may be they need to buy a product, but they feel like there's been a good analysis done, and since the planner doesn't receive any kind of benefit from recommending that product, that it is the product that they need. So that unbiased advice has become something that tends to draw people to the fee-only practice. I will tell you that planning truly becomes the focus. Planning becomes the focus. The products are incidental. And you go through the process of understanding what they need and analyzing and then recommending. And typically in a fee-only practice, you're going to have multiple generations as clients. So not only do I work with parents, but I might start working with their children, particularly as they move into adulthood. And that really makes sense in a fee-only planning environment because what you want to do many times is maintain that long-term relationship beyond working with or managing funds for one generation. A fee can be charged in a couple of different ways. Generally in a fee-only practice, we're charging a fee for the plan and for meeting with the client. That fee can be based on time, how many hours times your hourly rate. It can be based on just a flat fee, a predetermined amount that you're going to charge for whatever stage of the plans that you do, or a fee based on income or net worth, a formula of some sort. So any of those could be used in determining what the fee should be. Other services that are provided by a fee-only practice may include other things that they get paid for, like things as simple as bill paying services, tax preparation, or investment management services. And what I want to focus on a little bit more today are the investment management services. This is the additional service that is provided by the majority of fee-only planners, and it's the one that we use in our practice for as many clients who would like us to do that for them. It creates an ongoing relationship with the clients. You talk to your clients more frequently when you're managing money. We're emphasizing the plan, so we do the financial plan first. Then if the client chooses to have us actively manage money, and I'll go into exactly what we do there in a second, it's a kind of a continuation of that relationship. And I'm going to stay closer to the client. I'm going to be talking to them about their investments. I'm going to be communicating through performance reviews, at least every quarter. So I'm closer to them, and guess what? The more frequently I talk with them, the easier it is for me to keep up on those changes in their life that say we need to go back and make adjustments to the financial plan. So I think in our case, we do a much better job for clients when we do the financial plan and we follow it up with the active investment management. In our case, the client makes that decision, though. We may only do a financial plan for someone and then not manage money for a variety of reasons. It may be that most of their money's tied up in a company plan, a retirement plan, and until they actually retire, they don't have those dollars available for someone to manage. Or it could simply be that they'd rather do it themselves. And I always love that comment. And usually about 6 months later, they change their mind and come back in and say, maybe I really don't want to do this myself. But sometimes that's their decision as well. The fee paid by the client for investment management is based on percent of assets under management, which means that whatever dollars we're managing, we apply the percentage, a flat fee, or some use a formula based on performance. So only if the portfolio performs at a better rate than the benchmark would they get paid. You provide quarterly performance reports, which mean that we start out by, let me go back and explain what we really do in investment management. It might be a little bit different than what you understand here. We take in dollars from a client and we actually choose the investments that they should be using. And we try and make that portfolio diversified. In other words, if we're investing in stock, it's going to be invested in large companies, small companies, mid-sized companies, international, in a balanced portfolio. If we look at fixed income, we're going to do the same thing. Fixed income being perhaps CDs, bonds, treasury bills, in our case, whatever it might be. So we're going to look at a very diversified portfolio. That's our philosophy and our strategy. The client also requires us, and we do through the financial plan, determine how much should be in the stock side, how much should be in the fixed income side, how much should be in real estate. That's the asset allocation that I know you're all aware of, and we would do that work through the financial plan. So again, we're implementing the investment section of the financial plan is being implemented through the investment management service. So again, our client is well informed on what we're going to be doing with those dollars, where we're going to allocate them, where we're going to invest them, and then how we're performing with them. But the client gives us the responsibility of making changes in the account. So the client, in essence, sort of steps away and puts their trust in us that we're going to implement the plan appropriately and, again, have their best interest at heart. And what happens in that case, I get paid based on the amount of money that I'm managing. Well, guess what? My only motivation to make any trades in that account is for the value of that account to go up. Because why? I get more dollars as a fee the more money I'm managing. So the client, again, feels like I'm sitting on the same side of the table with them because I'm not going to make a change just to have a transaction, because that doesn't do me any good. I don't get any part of a transaction fee. So I'm only going to do things that will improve the portfolio, and they understand that, and that builds on that trusting relationship. So what we do is we give a report card every quarter. So we have reports that we mail out and provide a quarterly performance of that portfolio. We communicate with the client. They're welcome to call us with questions, and so we actively stay involved with the client through this process. We meet with the client as necessary. Some firms I know schedule regular quarterly meetings. We kind of leave that up to the client as to how they're comfortable and how they want to communicate. The advantage, the relationship extends beyond the planning process. There's awareness of changes in the client situation that then can turn back to update the financial plan. So as a successful fee-only practice, what would I say? We charge a fee for the plan. We charge a fee for any related services. We take a holistic approach, unbiased recommendations, long-term relationship, and we have a financial impact on their net worth. And it's really important to communicate that value to the client, because you remember, they're paying you to do this. And so sometimes you have to keep reinforcing how that performance is doing, either in their investments or their overall net worth. Now, we've had this conversation. Yesterday I had a 3-hour workshop on setting up a financial planning practice and going through some of these issues. And financial planning on a fee-only basis, I think, sounds very interesting. But a couple of things have to happen in your marketplace to allow you to do that. First of all, it's the consumer needs to understand and value financial planning. And that may be where that your market's not quite there, and that you may need to do a lot of public relations through the FPAM, as they're doing right now, supporting their efforts there, working with the press, and you individually continuing to communicate to the consumer what financial planning is and what the value could be to them. Because only when they understand the value will they come around and be willing to pay a fee just for you to lay all the facts out in front of them. So it's very important that they understand that and are prepared to pay a fee. And I think you need to determine whether your marketplace is there. And if it isn't, how do we evolve it to there if you choose to do that or would support that? The second thing that you have to be able to have a fee-only practice is you need to have your product providers to provide product that have no loads or no commissions paid out. In the United States, there's many mutual funds or unit trusts, as you have here, that have no commission tied to them. So 100% of my clients' dollars get invested in that fund. Well, that's how I want to practice. I want all of their money invested because I'm not going to take the commission anyway, and they're paying me a fee. So if I took a commission and a fee, I would be getting paid twice. So, I take a fee, so I want to use no-load products. So you have to have those things available. We have quite a few mutual funds, again, in the United States, that do not charge a fee. They're no load, and they're available and perfect vehicles for me to use in my clients' portfolios. We even have, and you may have been exposed to this too, some insurance products that are no commission or no load in the front too. I really haven't gotten involved in working in that area as much, but I know some planners have and use that again as another vehicle to meet a client's need or to implement a plan. So the important thing is that you need to respond to the needs of your marketplace. So if your marketplace needs to be ready for fee only, so if it isn't, you need to practice what they're ready to do. They may not be willing to pay a fee for the plan, or maybe only a small amount, and yet they'd be very willing to allow you to have the commission to once you implement the plan through the sale of products. So it's important for you to look at the total relationship with the client and do what the client will accept in your marketplace so that you can have a successful practice. And then as planning evolves here in Malaysia, there may be more and more opportunities to move in that other direction. Where fee-only planning really started in the United States would be through a bank or a CPA firm where they're not in the mode of selling products. At least initially in our environment in the United States, banks and CPA firms pretty much only charged fees for whatever services they provided. So when those two institutions began offering financial planning, that was the way in which they provided those services. So that's kind of how it got started and how we got clients to sort of accept the impact. I think we're going to have some time here, good 10 minutes or so, for any questions that you might have on fee-only planning or any other type of financial planning that you may want to commission only or fee and commission, or any questions at all. I answered every question everybody has. I am really good. Financial planning is a wonderful profession. I think we got one coming over there. And I tell you, once you get involved in it and you find the benefit that you provide clients, it's truly a rewarding profession to be part of. Yes.
Miss Elaine, my name is Patricia Tan. I'm from Public Mutual. I have two questions for you. First of all, how do you get your clients? And secondly, when you charge a flat fee, how do you determine the flat fee? And do you charge an annual retainer fee? Thank you.
Excellent questions. You might have to remind me of what they all are, but how do I get my clients? When I first started in this business some years ago, I was with the bank. And as part of the bank, there were certain clients of the bank that we started doing financial planning for. So the clients were sort of built in then. But I think what I would tell you now, that even through the CPA firm, you have to start attracting your own clients. And initially, I did an awful lot of public speaking. I wrote articles for the local newspaper. I did everything I could to get my name out there and explain what I do. Here's what financial planning is, here's how it can benefit you, and I'm certified, and here's how we do it. Those were the themes of everything I tried to say. And you just have to do it. You have to be out there and let people know who you are and what you do. And I would say that now, over the years, the majority of my clients come from my own client referrals. In other words, they're happy with my services, so they tell their associates, their friends, their family members, and that's where I get most of my clients from. And that's why, when I said earlier, I can't ever afford not to have a happy client. I can't afford not to have someone who feels like she did everything she said she was going to do, she gave me the answers to my questions, and I now feel organized, in control, and a lot less stress because I'm not nearly as worried about my financial situation. So those are always my goal with every client, because I'd much rather have them out there being happy than being negative and saying, she really disappointed me, I don't know why I paid her that fee. Oh my gosh, because that person's going to talk a whole lot more than the happy person probably. So I don't want to get involved in that. So that's one reason. Now, how do I charge a fee? I happen to choose the way of charging a fee based on the amount of time that I anticipate the plan to take. And my process is to meet with the client on the front end at no cost to the client. I just have a meeting with them where I gather the data, that second step of the process. I establish the relationship and gather the data kind of in that same meeting. And I take that data, and after the client goes home, I sit down and write an engagement letter. And in that engagement letter, I try and outline what they're trying to accomplish and give them the 4 or 5 different things in financial planning that we're going to address. Education planning, retirement planning, cash flow projections, those kinds of things. And then I quote a fee. And that fee is based on how much time I anticipate, based on how complex it's going to be, etc. The client gets that letter, they sign it and send it back, which tells me 2 things. 1, I heard them correctly and that's what they want me to do, and they're agreeing to that. And 2, that the fee's appropriate. You know, it only takes one time where you don't do that, and you send a bill at the end, the client says, whoa, I didn't think it was going to cost that much. So I quote that fee up front. Now, what happens once in a while is I have to put in more hours than I anticipated. But you know what? I'm going to make sure this client's happy. If they've got an extra question, I'm going to make sure I answer it. So that will happen every once in a while. Maybe sometimes you'll be closer and charge the right fee. So, I mean, assume the right number of hours. But that's how I do it for a financial plan. The next question, I think, is do you charge a retainer? I don't, but many planners do. Again, I charge the fee to kind of do the plan, and it may take 2 months maybe, or 3 months, to get through the entire planning process and come out with the final version of the plan. So we spend a lot of time together. And if we actively manage money for them next, in other words, I now am managing a portfolio and receiving a fee for that, I'll likely do some of that update maybe at no cost. So I may not even charge them if I have to do an update a year later. So I don't choose to do a retainer, and a retainer would be where the second year, I charge you a fee for the initial plan, and then I'm going to charge you maybe a fourth of that fee each year thereafter just to kind of stay in touch and update. I'm not saying that's a bad way to go. It may be a very good way to go. It just didn't fit well with what I did. So I've never taken that tact. We had a couple questions over here.
Elaine, my name is Danny Yap from ING. Now, in our environment currently, fee-based or fee-paying, it is not something readily acceptable. Mm-hmm. Mm-hmm. Now, coming from the insurance or the unit trust environment where we are now currently 100% commission-based, mm-hmm. the client get their advice FOC, meaning to say that free of charge. Going into the consultancy, going to the financial planning, what would you, how would you look at some of the obstacles that we will face in our initial transition into this arena? Mm-hmm. Mm-hmm. Question number one. Question number two, in my own perception, I felt that in the whole spectrum of financial planning, from the wealth protection, wealth accumulation, wealth management, and the wealth distribution. Mm-hmm. From the business point of view, I reckon that the third level, wealth management, has got the most amount of money. And if a financial planner would go into that and have a lot of money, a lot of fund under management, over years, this amount of money will snowball. And from the business perspective, it does make a lot of sense. What is your opinion on this?
I agree with that 100%. Let me answer it though a little bit more. Let me start with question number 2. What I think you're saying is that wealth accumulation, that wealth management appears to be the place for continued relationship and continued fee from the client. And that's exactly right. So let me take a second to just tell you, in my own firm, I probably receive only 12 to 15% currently of my total annual revenue from doing financial plans, from the fee for doing plans. The other 85 to 88% comes from management fees. But remember, I've built that up over a good 10 to 12 years. When I first started, I wasn't doing active investment management. All I was doing was the financial planning side. And so when I started getting into that, that's the ongoing service. So the financial planning fees represent new clients to my firm. The investment management fees represent every year adding new clients and continuing to build that up. So I have seen that continue to be a larger and larger portion of my total revenues for the firm. So that's really how fee-only firms survive in the United States, is by offering that other form of ongoing service. And I would say that investment management is the primary one, but also there's as I said, bill-paying services, or there's like family offices now that offer all kinds of travel arrangements, bill-paying services, walking your dog, all that kind of stuff, which I haven't thought about getting into, but there are other ways to get fees, obviously, then as well. Now, your first question, what do I see as the obstacles? And I truly believe it's communicating effectively to the client the value in financial planning advice for the sake of the advice alone. And again, I think until everybody in the community starts appreciating that, and they have to be educated to that. They have to understand through reading about it in the press and hearing about it from each of you and learning more and more. And that's when that part of the market. And the second thing, you need products. You need products that will work well in a fee-only firm, and those tend to be the no commission no-load kind of products. And so until you can get a good development of those products, it's going to be difficult for you to be effective. Okay, thank you. I think you have a question right down here.
Ms. Beadle, my name is Rajan Devadasan. I've got a very quick question. You've been in practice for a long time.
I'm very old.
You don't look very old. You started in
I feel
kindergarten. No, can I ask you, in your opinion, what is the ideal number of clients that a single planner can handle? And have you had to deal with situations where you've had to fire clients, either because you can't stand them anymore or because they no longer fit your the profile of your firm? You mentioned something about financial planning being very rewarding, and I think that's something that a lot of people in this room have experienced. But I found that a lot of people who can benefit most from financial planning aren't necessarily the kind of people who will park a lot of money with you to manage. And my fear, as the investment side of things begins to take over, there might be a tendency for planners to gravitate toward the high-end people, leaving the people who actually need their services the most, perhaps getting second-rate advice. So perhaps your comments on those as well. Thanks.
Very good questions. And you know, that is our fear in the profession as well. That, and it is sort of true. Fee-only planners tend to gravitate to the higher net worth individuals who are in the area, the time of their lives or the stage of their lives where they're accumulating wealth, which to me is the kids are out of the house, college is done, mortgage is paid down, you know, so you're starting to accumulate some dollars. And we do have concerns that maybe the middle portion of what we call middle America won't be getting the services. But this is an entrepreneurial business. And I will tell you that the more planners we get out into the public, the more we'll drive the cost of financial planning down where they can afford it, but also the more creative we've gotten. And there are some firms in the United States that have taken a very different approach. They're fee-only planners, but they charge by the hour. And what they tell their clients, and again, they're clients that probably have less complicated situations, and they really have maybe 3 or 4 questions that a planner with some experience can sit down and say, here's what you need to do. Let's go through this question, that one. So what they do is they charge so many dollars an hour. The client comes in maybe for a 2-hour time period. They bring their information with them. Right there and then, the client sort of goes through the planning process, talks to him, asks all the right questions, says, here's what you should do. 2 hours, they pay the fee, and they leave. No ongoing relationship. So it's only when that client, that particular client, feels like, oh, I've got another question, or something's changed, I need to go back and ask, that they'll come back in, pay the fee. So for that practice, the model seems to be working well. In fact, it's kind of been copied several times now. So we're kind of watching that with high interest, because it may be a good way to provide a different level of financial planning, but a good, thorough, helpful financial plan to that middle income group. So that's the way we're trying to approach it. And it may be something that some institutions will find and implement. We've had banks struggling many years trying to figure out exactly the right combination of how to provide that to that middle America, and that might be a model that they can kind of institute as well. Your first question was about how many clients. Was there another question in between as well? How do I what? Oh, how to fire clients. That's the fun part. No. Actually, I really like most of my clients, and I don't know how that happens, but I just get really lucky, I think. But every once in a while, there is a situation where we're not a good match anymore. Well, one case is sometimes we're managing money for clients, and for one reason or another, the amount of money declines. Hopefully not because we lost it in the market, but because they've had to use it and reposition it other places. And so it doesn't make sense for us to be managing a very small amount of money and charging them a fee. So we tell them, come back and we'll be happy to review it. So that's kind of a general, it doesn't really make sense for you to pay me a fee to do that anymore. We have had clients, though, that really just don't work with us. well, they come in and they want me to actively manage money for them. At least they say they do and they think they do. But suddenly they're calling you up and saying, I just got this hot tip. What do you think about this? Can we do this? And you're going, well, we'll look into it. And then they call tomorrow and they've got something else. And we say, wait a minute. If you want to trade in your account, you need to go find a broker, or you need to go set up your own little account and do that there, and let us manage your serious money, the stuff that we really want to do long-term management on. And so we've had a situation where we've had to do that a couple of times. But you know, I think if we do a good job of explaining up front this type of services we offer and the process we use and the method for doing our practice, we can get fairly good matches that way. So. But every once in a while, you do find somebody who's a little cranky, and you kind of work through the plan and then hope they don't want an update. But so we've been fortunate. Now, the other question was how many plans or how many clients can an individual work with? Right now, the way my practice is set up, I have 2 people who do primarily financial planning, and I'm one of those, and 2 people who do just the investment management. And many firms, the same person will do both functions. But again, it fit me better to be able to devote 100% of my time to financial planning and have somebody else devote 100% of their time to investment management. I just think it takes focus to do a good job. So that was my preference in setting up my firm. And right now, we probably have each of the 2 investment managers handling probably 140 client relationships. Now, I'm not sure they're totally saturated. Now, they would tell me every day they're working hard and they've got way too much to do. But, you know, so there may be some more ability to handle more clients there. They're required to look at the portfolio on a regular basis, talk with the client, and do those kinds of things. But probably my next additions to the firm will be an investment manager and then probably a financial planner as well. On the financial planning side, you know, I think that we probably look at a total of maybe even as much as 35 to 40 hours that we might be putting into a financial plan. So it depends on, you know, how many of the big plans versus the smaller plans that maybe only take 25 hours to work on to do that, as for how many somebody can earn. We have been pretty fortunate in that we probably have been working with 40 or 50 new clients every year. So if that answers your question, I don't know. Are we out of time? Doggone. This was fun. Just a wrap up. Thank you very much. I hope it's been helpful and you've got some information. So,
thank you very much, Ms. Patel. Ladies and gentlemen, now invite Mr. Lee Siew Hung to present a token to Ms. Patel.